Hello, welcome back to Beat the Banks podcast, where today we're going to talk about one of the things that banks do, and they do in huge quantities, and that's issue loans, right? They issue loans to consumers. And what I want to do today is compare that and contrast that to what it's like when you take a loan against your whole life policy, especially using the infinite banking strategy. So today we're just going to explore some of the characteristics and what it means to take a loan from a bank versus taking it for the whole life. And why is this important? This is important just from the standpoint of ease of use, control. And we're going to talk about all those things in just a little bit, but I hear a lot of people say, well, if this is so good, why wouldn't everybody be using it? This whole idea of infinite banking. And quite frankly, they're right. Why, if it's so good, why isn't everybody using it? The point is, there are a ton of people using it. People of wealth have been using this for years. People that are in the know, that are, especially in buying real estate world, in the real estate world, they've been using this for decades. So it's like one of the best kept secrets that are out there. But today we're just going to talk about one of the key characteristics. So let's get into it. Typical lending versus whole life lending. The first one I have a couple of key points I'm going to go through, but the first one we're going to talk about who you're borrowing from. So let's think about that from just a second. You go to Wells Fargo, you go to any traditional bank. Who are you getting the money from? You're getting it from the banks, right? Which isn't a bad thing, right? But where does the money flow? Think about this for a second. You take a loan from Wells Fargo, the loan principal and the loan repayment and the interest and the principal payment all flow back to Wells Fargo. Where if you have a whole life policy and you borrow against that whole life policy, where does the money flow? It flows back to an entity that you own and control. It flows back to the mutual insurance company. And then again, if we're doing it right, it's flowing back to your family bank, and then it will flow back to the insurance company. And what does that mean is that the dollars are now not going away from you, but rather being redirected back to an entity that you own and control. And again, we have to pay the mutual insurance company their interest because they could have been earning that somewhere else had they not lent us that money. But what does that mean? What does that mean to borrow money from a mutual insurance company? The mutual insurance companies are there for our benefits. They're there for the policyholders' benefits. And so when you have that in place, in essence, it's a company that's ran for your benefit, for your profitability, your policy. And so there's no reason for them to stick it to you. So they're out there saying, hey, we have assets. You can borrow against your policy. And that interest that's flowing back to the insurance company is going back to an entity that's going to benefit you in the long run. So, who are you borrowing from? Typical lender, again, where your money flows back to them, or back to an entity that you own and control by being a policyholder, which is the mutually owned insurance company. The next thing that we're going to talk about, requirements for approval. Oh my gosh, I hear this all the time. People trying to get a loan, especially people in real estate, people that have non-traditional loans. We've had some podcast where we've had guests on that said, hey, we're doing a house that's not traditional, so therefore we got to jump through all these hoops. But when they have their policy in place, what are the requirements for approval? All they need is enough cash value in their policy to be greater than or equal to than the loan amount. And that's and maybe one signature to get those dollars, depending on how big it is. So I heard it put this way, the requirements for approval, especially like on larger houses or maybe something a little bit more complex than just a smaller single family dwelling, has got tremendous cost of acquisition. It means it takes a lot of time and effort from your point. I even had one client say they need an extra pint of blood every time I go in the door, because whatever I give them, there's always that one thing right at the end, right before closing. Oh, by the way, we need this. Well, when you're doing it from your policy, all that's required is how much do you want and where do we send the check? That's the biggest point. I mean, think about that for a second. How much easier could you get? Now, doesn't mean you don't have your own responsibility, like, hey, what are your payback terms? And you have to determine that. But, we'll talk about that in a bit. But again, just what are the requirements? Typically with the typical loan, they'll need credit check, the tax returns, proof of income, debt to income ratios, all those things. So they can poke and prod you to see if you're worthy of them borrowing you some money versus the insurance company that says, hey, you got enough money in your policy? When and where do you want that check delivered? So think about that from the ease of use, especially for entrepreneurs that understand what what their time is worth. Most people don't put any value on their time. And I'll say, if you understand the value in your time, you'll treat things differently. And this is one of those cases. And so what does that process for obtaining a loan in a traditional institutional look like, right? You have the whole underwriting process, the application, the approval, denial, all the documents you have to get and the process for, again, taking a whole life policy loan is just that. Call the insurance company or send them a DocuSign with your signature and saying, what is the amount, how quickly you want to get it, and where does the check need to be sent. That's about it. So again, the underwriting process is something you have to go through each and every time with the traditional lender, where you only have to go through the underwriting process once with the whole life policy. And that's the time to see if you can get approved and if the insurance company will actually write a policy on you. Here's one of the big things. This is huge to me. What are the repayment terms? When you have a typical lender, who sets the repayment terms? Right, that's right, they do. And you're locked in, and it's set by the lender. And there's really very little flexibility when it comes to the repayment terms. Where if you have a whole life policy, this is the beauty of it. It's very flexible. It's all set by you. Doesn't mean that it's free. All I'm saying is that it's flexible. And so with flexibility comes responsibility. And so you have to say, hey, I got a plan to pay it back. And we actually have, if you go out to factumfinancial.com, we have some resources there. We did a deep dive last month, and you can go look in our deep dive section of our training videos. And we talk about the process of taking a loan and the why you should take a loan and how you repay it back. And we go into that. So again, go on to factumfinancial.com, take a look, find the deep dive section, and go to the November deep dive of 2023. And there's a great 1 hour Zoom meeting that we did just on the process of taking a loan, the whys and kind of the ins and outs of doing that. One of the things that's a big benefit of taking a policy loan with a whole life insurance policy versus a loan from Wells Fargo is privacy. You think about it, we don't want the government in our schools. We don't want the government in our religion. We don't want really the government anywhere, but we invite them into our lending, into our dollars. We invite the public into our dollars and our conversations about money because it's all public record. So from that standpoint, again, privacy, it's huge. The only reason that people will know that you have this is because you're talking about it and telling everybody how easy it is and how simple it is and how, nobody else can see it unless you're out there talking about it. Another key aspect to think about is ownership and collateral. Collateral, for the most part, is required on all loans today, especially anything of any significance. And the lenders are going to take ownership of that collateral, if you default. So think about the danger, the uncertainty that you're putting your family into versus when you take a policy loan, only collateral is the cash value of the policy. And so again, that money's there, it's earning, it's growing, it's protected, it's guaranteed, it has all the benefits. And you're just using that piece as collateral. Where if you're a farmer, for example, you got to put your livelihood up in order to get a loan. You got to put your land up, your equipment up, your cattle, whatever it might be. You have to put that up as collateral. And if something happens, there's a bump in the road, they can, in essence, take your livelihood away. Think about how uncertain that is in your life. And do you want more certainty in your life or less certainty? I'd raise my hand and say, I want more certainty. Approved loan uses. Well, this is the big one. Again, these are all big. So typically your loan that you get from Wells Fargo is, unless it's a line of credit, it's single or restricted use, right? So it requires disclosure of the purpose of the loan. Now, home equity line of credit can be pulled at any time. Typically it has a high interest rate. So what you have with your whole life policy, when you take a loan against it, you can have unlimited loans, and every dollar you pay back in excess of the interest can automatically be loaned again the next day. Think about how powerful that is. You don't have to sit there, well, I paid the car off, now I have to go get another loan to buy a truck for my spouse, or I don't have to go take a loan to put a down payment on a piece of rental property. So every time you do that with a traditional lender, you have to go through the process. With a whole life policy, it's nothing along that lines. So, and you don't have to even tell them what you're getting it for. They don't ask. So what are the consequences of non-repayment? We kind of talked about this a little earlier. Consequences of non-repayment. Again, you forfeit your asset when you take money from Wells Fargo. You're playing by their rule book. And what their rule book says is that if you don't pay, and they have some really strict rules around that, you potentially lose your asset. And so or garnishment of wages, or hurt your credit. All these things will impact you and your family. Where if you have a policy loan, what's the impact of non-repayment? The loan just gets bigger. It just adds the interest to it. Now, I'm not going to recommend that that's a long-term strategy. I'm going to tell you that's a very short-term strategy, but it can happen. And it happens with a lot of businesses. It's happened to me in the past where, we've bought a piece of property, looked great on paper, had a great tenant. And, 2-3 months after we owned it, she punches holes in the wall and tears off doors and then skips the country. Okay, if I would have had a traditional loan, what do we have to do? The insurance companies, they're like the bookie collectors, right? They're pay me. They don't care what the excuse is. All they say is pay me. Here, you're the one that's in charge. And so you can say, hey, maybe we're going to do interest only for 6 months or a year until this property gets back up on its feet and starts producing a cash flow. Unlike, again, going back to Wells Fargo, all they want the first of the month is pay me. So there's no grace there. There's just, you have to, because you're playing by the rule book. You have to hop on board and make their payments. Or again, if you take a policy loan, you're the one that's making up those rules. And again, with rules comes responsibility. With flexibility comes responsibility as well. So what happens? We just typically increase your policy loan to add on the interest that wasn't repaid or isn't going to be repaid, which does reduce the death benefit a little bit by about that amount. But if something happens to you, all that debt is wiped off the books. So now, instead of receiving a payment notice, your spouse or your family or your trust or whatever it is receiving cash and cash at the right time. So to that point, when you have a mortgage, you have a loan, and you die, and you have your children inherit that, what do they inherit? They inherit a liability. Think about that. You have a house. Just because you die doesn't make the bank wash its hands and walk away. The children inherit that liability, the obligation to pay if they want that house. Where with a whole life policy, going back to what I just said, they inherit an asset. That asset just happens to be cash. Now, cash minus what was owed on the loan, but it's still cash. And cash solves a lot of problems, especially at time of death. There's always something to be paid. So cash is a tremendous asset. Okay. So we talked through all those different things. There's a lot of reasons why you'd want to take a whole life loan over a traditional bank loan. And I don't know anyone that could argue with that, especially somebody that's been in it, that's experienced it. It's real easy to explain that. But somebody that hasn't actually experienced what it's like, it's hard for them to even grasp what that means. So all I would encourage you to do is, go on to factumfinancial.com, go to our education material, take a look around, get educated, understand what you're getting, find an associate that does this for themselves and does this for clients on a full-time basis. And we're here about education. And you'll understand that ultimately what the biggest benefit is that we haven't talked about is control. Who's controlling the financing in your world? Who's controlling the financing in your business? Who's controlling the banking function in your business? I can tell you that if you can't say that you are, and again, when you say you are, you have to be honest. Are you the one that gives a thumbs up or thumbs down to any project? Or is it the banker? If they're saying, hey, we got to approve this, or we have to, you have to come to us to get an approval on it, then it truly isn't your business, is it? You want the freedom to run your business. You want the control and the certainty to run your business. But if you're not the one that's making those decisions, ultimately who's financing, who's in control, then you're not in control of your business. So I would just have you consider those points. Think about this from a standpoint of, think about the last time you took a loan out to either buy a piece of property or do whatever it was. Think about the pain and agony. I don't know, agony, that's probably a little over top, but whatever. But the maybe a little bit of nervousness about, gosh, am I going to qualify? What's your credit rating going to be? What's my interest rates? Where if you go take a policy loan, man, it eliminates all that pent up frustration, because you already know what the interest rate is. You are automatically approved up to the amount of cash that you have in your policy. And now all you have to do is determine what terms you want to repay back your banking system. And you got to love yourself and love your family more than you love Wells Fargo. And what I mean by that is you have to step up and say, okay, I know that there's a lot of flexibility with my policy loan, but I have to treat it better than what I would if it would have been a loan from Wells Fargo. So think about that for a little bit. We have other podcasts that talk about that, but again, go back through the last couple times you've taken a loan. Has it been an enjoyable process? Has it been an easy process? Or is there some uncertainty? And if there's ever any uncertainty, then you should be looking at this process. It's called the infinite banking concept because it can be used for infinite amounts of ideas or purposes. And it really starts with a properly structured life insurance that you need to capitalize. You need to save dollars to make this thing happen. But once you're there, once you find that freedom, you're never going to go back. You're never going to want to go back into a traditional bank and fill out a 27-page loan application, because that's a tremendous waste of your time. And if you think about how expensive of a process that is, expensive in your time. Thank you very much, and we will catch up with you soon.